Good evening, everybody. This is Ken Cavullo from the Mid-Michigan chapter of Better Investing. This is our June 2024 Investing Roundtable. We've been doing this program now for close to 14 years, and we have a great time doing it. We hope you have a good time listening to us blather on about stocks and our ideas. We hope to give you some really good choices this evening, and when we finish with our poll, I would hope that we'll pick the best of the three stocks that we're going to be presenting tonight. Let's get to some of the housekeeping really quickly. We do have a disclaimer that we have to go over. And the disclaimer basically says that everything we talk about tonight, even though it's real stocks in real time, is for educational purposes only. We are making no recommendation to buy, sell, or hold. If we own a stock in our personal portfolios, we'll try to disclose that as we talk about the stocks. If you'd like to be reminded about the roundtable, you can drop an email to ncavullo1@comcast.net. That's my wife, Natalie, and she will add you to our guest list. But it's so easy for you to add to the guest list as well. If you go to the Better Investing website, and that's at betterinvesting.org, and put a few slashes after it, do /chapters, and then /mid-Michigan, you'll get to our homepage. And if you scroll down the homepage, you got to scroll a little bit because it's not immediately obvious. You'll find this fill in the blank thing right here that I'm looking at. I'm trying to come up with words for to describe it. It's a form, and if you just fill in those 4 lines and hit subscribe, then you'll automatically be added to our guest list. What will you get? 1 email a month from Mid-Michigan, which will tell you that the roundtable is coming up, give you the date, and give you a link where you can register for the roundtable. If you, in fact, do register, then GoToMeeting will remind you that the meeting is coming up. It'll give you a week's notice, and I think it'll even give you a notice a day and maybe even an hour before the meeting's going to begin. But that's all that will bother you from Mid-Michigan, at least. 1 email a month just telling you about the roundtable. And if we're running any more national programs that are free and open to the entire country, then of course we'll inform you about those in that same email. Let's go one more tick if we can, Mark, and see where we're at. And I'm going to turn over to Mark now, and he's going to talk about some of the screens that we've been taking a heavy-duty look at. Those are our real email addresses at the bottom. If you'd like a copy of the slides from tonight, you can email Mark R. at manifestinvesting.com. If you have questions for either one of us, both of us will be glad to respond to questions. And it's really important that you understand that we're volunteers and we don't sit at our computer 24 hours a day, only maybe 16, 18 hours a day. So we'll get our answers back to you just as quickly as we possibly can. But this is summer, and summer is very, very short in Michigan. And so we'd like to take as much advantage of the couple of summer months that we have and do some things that we don't normally do. So further ado, let's get to the program itself. And the program itself will be on the next slide, I think, Mark. And I'll turn it over to you.
All right. I was just sitting here trying to figure out if I could put size, name, and address in that form and get him a reminder. You just know he's watching the Braves play the Cardinals, and he's going to claim technical difficulties. So we'll see. All right. Well, one of the things we thought we would do tonight, we did expect to have Hugh McManus with us along with Cy, so it would have been the 4 original nights. But we just thought we would take a moment to just give a sampler. This is the type of list that you would get in a spam email promoting the roundtable if we charged anything for it, because they only talk about the 100% and 200% winners, right? Well, what you're looking at is a list of the individual participants' personal bests, and the shaded out, kind of the yellow background positions are closed positions. So they basically are sales that happened and locked in those positions. But the rest of them you can see are somewhat entertaining. Of course, the Ardelyx, uh, what would you call it, Ken? Like a crusade campaign, adventure?
All of the above, Mark. Okay.
Because Hugh McManus first brought us Ardelyx, I think about 7, almost 8 years ago. And at a stock price in the $14 to $16 range, it went and actually approached zero at one point. But we do have 8 or 10 positions in the roundtable tracking portfolio, and I'm the lucky beneficiary of picking up shares at 57 cents, watching it go up to 10 and then drop back to 6. So yeah, it's an adventure. But Herb Lemkool's selection of NVIDIA is there. Now Ken's fairly recent selection of Fabrinet is right there. Again, Kevin Galogli has had several good selections. His top one so far is KLA, and that came with a fairly comprehensive rundown on the semiconductor industry. So again, a tip of the hat to Kevin, and nice selection. Like I said, he's got a few more of those. Simulations Plus is a Ken Kavula favorite, but Cy Lynch picked it and rode it to some pretty massive gains. And then you see some of the other guest knights and damsels to round out the pack. The BP entry there by Hugh McManus was in honor of the oil leak in the Gulf of Mexico many years ago. I don't know. I don't remember what the incident was at the time here, but he's notorious for diving in on stocks that are in a precarious situation. He refers to it as loathing when they're fully loathed. Can be an interesting thing to take a look at. And rounding out the pack there, Candace Baker with her fairly recent selection of Air products. That's doing pretty well coming out of the gates. And Matt has been a Camping World fan for quite some time. I don't know. Matt, do you still have your mic on?
I do.
What's your perspective on Camping World these days?
Well, I did get out of it last year because I thought going into the increasing interest rates, there's so many of those vehicles, and we've had a little discussion, not just RVs, but also boats and other recreational vehicles are financed. That's an important part of it there. I really like if you see a lot of shade, we talk about not quite loathing, but some shade being thrown the way of the RV OEMs like Thor. I've always liked Camping World. They are what a business strategy class might call a channel captain. They get to dictate what happens because they are the biggest customer, but they also importantly deal in used trailers, used vehicles, which the OEMs do not. And so they still are quite cyclical. They will, as volumes turn down, their earnings will turn down in that year. But they survive in a much smoother, calmer waters because they can not only deal in used trailers, but they also buy them at a point where people are trying to get rid of them just because they've went onto the euphoria. So they are certainly Marcus Lemonis is a savvy market player. He's been a dealer before RVs. It was cars for a long time, but they are the behemoth in their market. Still with a lot to go. Still planning to double locations by 2030, and with the wherewithal to drive not only the purchase of trailers but the maintenance of trailers that they locate. Not just in cities where people live, but out near the destinations where they go, because that's where RVs tend to break, as well as with their Good Sam product. They are the frequent flyer card of RVs as well. So comprehensive portfolio if you're interested in the space.
Okay. Matt, my son-in-law works for an RV dealer, quite a large one in the area here. And he indicates that they also sell used vehicles, used trailers, and RVs. And he indicates that the profit margins on used vehicles is actually better than the profit margins on new vehicles. Is that true industry-wide, or is that just something unique to his particular unit, his particular business?
No, that is true for Camping World, and I mean it's generally true for all dealers. Even car dealers are that way as well, because they aren't dictated what the price should be, and it didn't always used to be the way. But speaking now of passenger cars, you know, the MSRP, the manufacturer price, is much more closely dictated than it used to be. So the margin is not as big as it used to be. But certainly for RVs, for Camping World, but also in general, yeah, used brings bigger margins. Again, still cyclical, but they have that pricing power that they never have to buy a used trailer from someone trying to sell it, but they always can. So they have some leverage there.
Great,
All right, good
great
stuff. Yeah, and it sounds like there's opportunity unfolding in that area as we speak between the RVs and the luxury boats and all that stuff right now. So
if you're new to our programs, you might not understand what that last column is talking about. It's simply a subtraction. The column, the relative return column, you can use other English and think of it as how much did you beat the market by in the period that you've owned it. So on the first one on our Delex, since June 28th, 2022, almost exactly 2 years ago, it was purchased. It has returned in total 230% annualized. The market in that same exact period of time has returned 20%. So one minus the other gives you a relative return of 210%, or it's beating the market by 210% in the 2 years, every year that we've owned it. And all the way down the column is reading like that. This annualized total return is what you normally see when you look at facts and figures from the analyst community.
Yep. All right. So now those are the ones that make us smile. These are the ones that make us grit our teeth. So this is our hall of humility, and everybody has some of these. Again, as we say here quite often, you can do the best stock study in the history of man. I've been accused of doing several per year. Sometimes it just doesn't work out. And
I'm honestly surprised, Mark, that there's still 4 open positions here in this stock. Okay, in this list. So
hope springs eternal.
Yeah, size is not here to defend himself, but we have talked about getting rid of Teletech, and I think it's probably too late now. We'll take a look at that here in a few minutes. I was kind of hoping Cy would be here, but maybe it's just best that he's not at this point. General Electric, he rode that for a while, and it actually turned out fairly well after that. First Foundation, of course, it went through the old Silicon Valley Bank crisis, and it's never fully recovered from that. So I still think it's a pretty good enterprise, Ken. I don't know. What's your latest work on First Foundation suggest?
Oh, Mark, you know, I tend to, when I leave a stock, I tend to really leave it. So I haven't even looked at First Foundation probably in the last year and a half or so. I was fascinated with it at one point. I like the concept. It's a bank, and it just never has seemed to put itself back together again. So I don't know much about it today, Mark.
Okay, and the next one, that takes us to the selection that Kevin Gologly will never let me forget or live down. A2 Milk, the New Zealand milk company. It actually recovered quite a bit to get to where it's at there. Pretty
I
rough
think it
run.
had gone down under $1, hadn't it, Mark? I think it got down under $1. So.
Is Kevin in the audience? He seems to track it.
Kevin is in the back room
here,
with us right
and
now.
I have my own Hall of Shame right below you.
Yeah, but yours is still a good work in progress. Mine's locked in. I don't know. I remember it getting down around 2, and much like you, Ken, I kind of close my eyes and try to forget it. But it did go up 30 or 40% recently. And I know that because Kevin sent me an email telling me that. So
we do have a hand in the air, Mark. I'm going to unmute Petra. Petra, I can't unmute you. You have to unmute yourself. And if you do unmute yourself, then you're free to ask your question. And we call that at the round table an inadvertent hand. So I'm going to take the hand down and hope that Petra puts the hand back up again if she really did have a question and is able to unmute. Okay, go ahead, Mark, continue.
Okay, Kim's selection of cricket didn't work out so well. I thought that Candace and I both selected Generac that evening, and I thought that was going to be an absolute winner, and it's been pretty sluggish since then. And I really liked Matt's selection of Altisource. This is years ago, back in August 2014, and I really liked the business model. And that one just didn't. They didn't follow our instructions, Matt. Is the problem there?
No, yeah, and there's no recovery story to regret either, so that's okay to leave it right there.
Okay, and this is the list you want to be on the bottom of. And Ann Manning is notorious for having very few of these type of situations. In fact, she is our all-time leader in the number of winners chosen versus losers. So this is an unusual position for her. I have expected her to end up with a positive relative return for her worst selection, which would have been kind of cool. But again, these are the humility moments, and it happens in investing, and you just have to take a deep breath and press on.
And again, just to remind you folks, the yellow backgrounds on that graphic on that slide mean that we've closed that position. So there's no hope left for it to recover and help the portfolio. We do have an open position in TTEC. What's that? Teletech? Is that the name of the company, Mark?
Yeah, they changed it to Teletech or TTEC because they're trying to hide, but.
Okay, and my first location in Darling and Five Below there. Yeah. Cy, you're with us. Okay, we're glad to have you here. Okay.
I wanted to change my name though.
Well, you didn't want Lynch next to that first one there, Cy?
You're okay on the previous page, Cy. So this one is just we've talked about this one. And I think, and what I looked at an article before we came online tonight, and I wanted to share that here. I'm not going to read it, but I think Cy picked this at a good time with all kinds of good indications, and I think it's a microcosm of the entire consulting industry. And as you read down that list on the right, that's from a report by Donovan Jones over at Seeking Alpha. What it basically describes is a very macro global slowdown. And it just drives companies like this crazy. They're actually in it's a consulting firm. And Cy, did you see anything on there that you would disagree with? I think they're having trouble deciding the manpower situation and where to pursue business. And I think this also dovetails very nicely with the type of challenges faced by EXLS, Accenture, and everybody else. McKinsey is talking about layoffs. So the situation is probably temporary, not terminal, but boy, is it nasty, especially in this case.
Yep.
Any other thoughts on that? You don't?
No, I think that's about right.
Did you pick this one for the Better Investing magazine, or did you avoid it successfully?
I think I avoided it in the magazine. I just did it here.
Mark,
we did. You came in after we talked about the winners, but we did celebrate your bests. We went to your worst choice. Okay, Mark was kind to all of us and showed people our best choices first before he put the worst ones out there. So
yeah, and one thing I wanted. Mark, if I could go back, when you were talking about name changes, it reminds me of a quote from Peter Lynch in One Up on Wall Street. He goes that there's only two reasons why companies change their name. It's the same reason why humans do it. They either got married or they're trying to hide something that went really, really bad.
Well,
I think, Mark, this one could be the poster child for why you really sit up and take notice when the quality starts to degrade itself.
Yeah, that, and just notice how relatively mild, at least, from a visual analysis standpoint. I lost my cursor here. this projected slowdown here, which obviously has been receding, does not look all that major. But look at what it's done to earnings, the expectations for this year, and they could be looking at their first negative earnings results if it persists. So yeah.
And there's the scale is kind of hard to read on the quality graph, but that most recent quality is, I'm reading it off to the left over here, and it's down to 20 now. So that's certainly not where it was purchased with a quality of 20.
No, Psy is in back here with a high quality, high return forecast. So
yeah,
it's just been it's been brutal, but again, microcosm of what we're kind of watching for all those consulting companies, and it'll be interesting to see how that continues to propagate. All right. So with that, let's go into talking about the performance of the overall portfolio. We have much more celebration than the humiliating moments historically. And what it adds up to is, if you take a look at our tracking portfolio over the last 14 years, the rate of return since inception in 2010 is 17.1%. Mirroring or matching investments in the Wilshire 5000 would return 12.1. So as Ken was saying earlier, 17.1 minus 12.1 gives you that 5% relative return. That is our goal. And it's the goal of most investment clubs to try to beat the market by 5 percentage points. And again, something to celebrate, guys. We seem to be hanging in there pretty well, despite challenges with a couple of the companies.
Mark, Mr. McManus has arrived with us.
Excellent. Greetings, Hugh.
Hey, hello. Sorry, jet lag. I fell asleep this afternoon.
Not a problem. Understandably. With your travel schedule, I don't know how you do it. But anyhow, we are looking at the pretty decent results. So thank you, Hugh. Thank you, Cy. Thank you, Ken. And all the guest damsels and knights out there. Pretty decent track record. We do find that 45% of our selections are beating the market. So we call that a 45% win percentage. We actually would like to see 55. But here's a fun fact that we'll share. Roger Federer, in a recent graduation address at Dartmouth University, shared the fact that he's won 80%, or during his career, he won approximately 80% of the matches that he participated in. But when it comes down to the individual points during all of the games, he actually only won 54% of them. So that matches that 55% number from Tillinghast. And it's just kind of fascinating that you can generate such a wonderful winning percentage, winning only a slight majority of those points, and that probably among the best. So Federer's advice, anytime you get one of these, is to take a deep breath and get back there and swing the racket again.
Absolutely.
I think it's pretty cool.
Yeah. Mark, I want to admit, when I look at this graph and I think back to years 1, 2, 3, 4, even up into year 5, that I thought that dotted line was so far away that we were never going to get there. Okay. And then suddenly in year 5, we took off, and we haven't kind of looked back since. There's a lot of ups and downs month to month, but it's stayed up there right around that +5. And if we can do it by just kind of picking stocks and talking about them, then we're reasonably certain that a well-run investment club can do the same thing.
Absolutely. Well, here's a quick look at the top 20 holdings in the portfolio by percent of assets. The legend on the upper right, it just tells you how many times each individual stock has been selected. So in the case of Microsoft, our number 1 position, we've actually purchased that 5 times. It's over here. Here's Microsoft. So 5 times means that every time it's been selected by either a knight, a damsel, or the audience, we put $1,000 into it. So $5,000 invested in Microsoft is now worth $113,000, and that makes up for a lot of those other humiliating moments in the other slide. So You can see all of the positions. There's another 40 positions or so in the active tracking portfolio by going to this link up at the top of the page. That's a public link. We won't know that you visited. We certainly don't place cookies on anything, but you can take a look at all of the individual positions in the tracking portfolio. Your thoughts, Ken?
Well, I've shared this slide, Mark, with friends in some of my investing clubs, and they look over at the left-hand column and they say, if these are your largest holdings, why are you holding on to some of these PARs at 5, 5.5, 4.9 even for Regeneron? And I point them to a kind of a buried sentence in one of the investor manuals where Mr. Nicholson basically gave the advice that you should be very, very careful before selling a company that's growing its sales by double digits. And you should watch it very carefully and really have great reasons why you need to sell it. Because if a company can continue to grow at double digits, then you're liable to be in a really good position over the long run, much more liable to be in a good position than you are to be in a stagnant kind of a position. And if you look at most of these ones with the lower PARs in that far right column, you'll notice that their growth column, and that's sales growth, and that's sort of in the middle of the table. You'll notice that that growth column for almost all those companies is double digits, or it might be a 9.9 or a 9.8, and frankly, I'm going to call that double digits just from the rounding errors that can occur. So we're holding on to them because we really believe that Mr. Nicholson had stumbled on something that was, he didn't stumble on anything. Mr. Nicholson had posited that it was a really bad thing to really move these kind of stocks out of your portfolio, even when they got a little bit ahead of themselves. I think it speaks to be patient. Because what will happen is that these companies will readjust their PEs. They'll readjust the momentum that might have moved them ahead very, very quickly, and they'll be back to growing at places that you're very comfortable with for the long term. And that's why we're holding these slower PAR values because they have the growth that really helps us. I guess the ones we should be looking at are maybe a couple of these where the growth has moved down considerably under double digits, and they might be ripe for us to consider whether or not we need to keep them in the portfolio. And even though I love the company, I guess I'm focusing right now on Fastenal, Mark.
Yeah, I was just looking at it myself. A little bit slower growth. I mean, it's still very mature. It's an excellent company, but if they have a pretty solid run on their price and drive down that return forecast, that is one that would probably end up on the hot seat. We'll probably do in the next couple of months. We'll probably do some weeding and trimming of the portfolio.
Right now, that 8.1% is very close to the market average. We're measuring the market average with a couple of different metrics, some coming from Value Line, some coming from Manifest Investing, and we think the market average is somewhere around 9.5% right now. So that 8.1 is still very respectable return. But and it's good return for a core company, and Fastenal is definitely a core company, but the sales growth is really lacking, and I don't know if, in fact, the sales growth is something that Fastenal is going to be able to move in another direction. It's getting to be quite a large company, and sometimes it's very difficult to move these large companies. The other one that comes to mind is the one that my club just moved out of their portfolio, and it's Cognizant, up there about halfway down the list. Yeah.
Yeah, and in fact, I attended size class on portfolio-centered decision making, so I can just hear him bristling at. We should always be constantly trying to raise this.
Yep. Yeah.
By a few percentage points over 10. Si, you want to disagree?
I'll disagree. No, absolutely. We want to be raising it. Yes.
Yeah. So we want to be constantly thinking of that. And again, you don't have to panic, but we'd sure like to drive that back more towards 14. The quality's fine. The overall growth rate on average is fine, but the PAR is a little bit low, and part of that is because of this and this number. So it's a celebration of success, but it's also a recognition that you want to always be out there trying to maintain that a little higher if at all possible. Right?
Yeah, what's saving Cognizant right now is that 11.6% par.
Yeah.
And that's above average, and that there's no reason to move it out because it's actually about a tenth of a point above the portfolio's average. So it's not hurting the portfolio, but it's not doing a lot of help to it either at this point with that kind of sales growth.
Yeah, and the one thing about Cognizant, and I own it personally too, and I struggle with it, and it also is in the magazine as well as, of course, we talk about it here, is the 4.6% real because Cognizant has grown and because the consulting industry is just slowing for its mature companies? Or is it, as has been the case in the past with Cognizant and many of the other consulting, is that the rhinos turn against it when there's any sort of economic slowdown?
Absolutely.
And so, and that's the question. I mean, if 4.6 is real, Cognizant's obviously a mature company, and we'll never see the past return. I mean, that was a much smaller, faster growing company, but it would not surprise me to see that rebound into the 8-9% or so. But,
And Cy, I'm not as sanguine as my club is, and I still own Cognizant as well, and I'm still grappling with whether I'm ready to throw in the towel and look for a replacement or not. It's a key pillar in my portfolio. It has been for many years, and my PAR is creeping down towards average, towards that 9-10%. But my age is creeping up there, and I'm getting more comfortable with nice 9-10% returns than I used to be. So it all plays a part in this very difficult idea of keeping your portfolio vibrant and managing it for growth. Yeah.
I will point out that the last two bull sessions, we do a session on Tuesday afternoons at 2:00. The last two, we have talked fairly extensively about the consulting industry, and I'll try to remember to point those out when we pull up the YouTube slide later on. But we took a fairly detailed look at Cognizant, and I'm with Cy. I mean, they have plateaued in recent years, and anybody who's either interested in it or owns it would do a good. It'd be good to take a step back and see, can they harness something like that going forward, and basically turn the aircraft carrier and get it back on a higher growth rate. All right, we better press on, guys.
We have Len out in the audience reminding us that we made a terrible decision based on some of that same kind of reasoning about Apple quite a few number of years ago. Len's been with us for a long time as well.
Yeah.
So he has a long memory, and he's not afraid to remind us about boneheaded things that we've done in the past. So you're right, Len. I think that our thinking on Apple was a little bit too formulaic, and it wasn't nearly as nuanced as we've become in our decisions to prune the portfolio nowadays.
Yeah, and that just triggers one other additional thought with EPAM systems, and Cy kind of navigated us through this. EPAM had a heck of a challenge with the war in Ukraine, and the company completely tanked, and we're somewhere in fear for its survival. And Cy basically said, "Hey, these guys still got a pretty good business. They're relocating resources around, and EPAM is actually a pretty good demonstration of how quickly these type of companies can recover from a significant challenge." So it's worth noting and learning from that case study also.
Yeah, and EPAM still has made us pretty decent money. You have to. That's a 7-time pick that's now worth $11,000+ plus. So it's made us money, and it's giving us you know, it's not disappointing with a par that's above our portfolio's par average, even though it has the lower sales growth right now.
And they're faced with all the same challenges and
Right.
issues that the others are.
Yeah, because EPAM exploded even better than it's looking here in the recovery phase of what you were just talking about.
Right.
But then it hit the consulting wall too and pulled back. So
Absolutely. All right, let's go ahead and press on, gentlemen. And with that, Ken tells me this slide was prepared using artificial intelligence.
Well, that's what I was told this afternoon, that this is an artificial intelligence prepared slide without that thing in the bottom right-hand corner. I don't know where that came from. It was not part of what I turned in for my presentation.
I can't explain it either, Ken. It's just
I know it just appeared. It just appeared. Okay. That's me eating my first Portillo's hot dog in Chicago at the convention. So it certainly is a hot dog that tastes really good, but boy, is there a lot of stuff on it, I'll tell you. All right. My company for this evening is LVMH. Some of you might know it as Louis Vuitton. You might know it as Louis Vuitton Moet Hennessy. There's all kinds of names that are attached to this company, but they are now going by the call letters LVMH, and their ticker is LVMUY. One of their most one of their longest customers, one of their longest houses, as they call them, is Christian Dior, the fashion house. And Christian Dior is a supplier and has its own place in most Saks Fifth Avenue stores. And all of those things are directly associated with this LVMH, this Louis Vuitton company. Next slide, Mark, please. Louis Vuitton is the world's leading luxury goods group, and here's some facts about it. When it says maison, that's the different units that are in the company, and they have 75 of them. You know, normally we talk about a company with 3 or 4 business units, and there's 75 distinct business units in Louis Vuitton. That gearing down in the second column at the bottom, the 17.1%, that's a French word for basically debt. Long-term debt. So they have a pretty decent debt number that they use, but they don't calculate debt exactly the same way we do. All of the dollar values that are in here, all the monetary values in this slide are actually in euros, and we have to understand that euros are worth about $1.30 in the most recent read from the Eurozone. So Louis Vuitton is present in 81 countries. You don't realize how huge an employer it is until you see the employees number, you know, over 200,000 employees worldwide and over 6,000 different stores. Let's go to the next slide if we could, Mark. They're in 5 larger divisions, and they put their different maison, their different units, into 5 divisions. And the first division is called Wines and Spirits. This is the only division having a little bit of business trouble right now. Wines and Spirits are not selling as well as they used to. That's true about normally priced wines and spirits. It's true about luxury priced wines and spirits, and it's even true about things like beer and cheap wine. They're just not selling as much of the alcohol that they used to sell. And one of the easiest reasons to point to is the proliferation of marijuana as something that is legal and increasingly acceptable in many parts of the Western world. You can see the profit that they make from this division. They make an operating profit of 32%. Kind of keep that number in mind as we move through. And if you drink fine champagne, even occasionally for a really important celebration, you might recognize some of the champagne names on this list. Hennessy is a a huge brandy, a huge cognac label, as well as a lot of other spirits with Hennessy. And this is just luxury goods at the pinnacle of whatever the luxury class wishes to define as luxurious. Let's go to the next slide, Mark. The second division is fashion and leather goods. This is the largest of their divisions, operating margins of almost 40% in this division. And again, you look at the different labels right there, and you should recognize some of them as aspirational for a lot of people, and the very, very wealthy, actually wear these things and buy these things. We have a mall here near us, about 45 minutes from my home, that has stores that celebrate these brands. And we walk by them, and my wife and I just gasp at the prices on some of these things. I can't imagine spending the kind of money on a shirt or a pair of trousers that you would have to spend to buy some of these brands. But there are people that think that they're getting their money's worth when they do that, and that's what makes a business for Louis Vuitton. The next major division, next slide, Mark, is watches and jewelry. They not only make their own watches and jewelry, but they make them and then rebrand them with some of the brands you see at the bottom right here. And again, aspirationally, a lot of you might say to yourself, boy, I'd like a Bulgari watch or a Tag Heuer watch. I'd love to have one of those. Watches and jewelry are fairly low margined for Louis Vuitton, only 20%. Now, we know that for most companies, a 20% operating margin is really a very healthy margin. So when I say that this is the lower of the margins in the various divisions, you begin to get an idea of the kinds of money that this company makes in net profit and everything. Next slide, Mark. They have perfumes and cosmetics, even a lower margin for that, less than 10%. And again, they make the perfumes. They're a manufacturer of some of these things, and then they put the brand name on them. There are not, each of these companies does not actually make their own perfume, but they parcel it out to companies that deal with that. I think we might be talking about that in the next presentation a little bit, but they are unique to different companies, and of course then they're branded with names that are worldwide known. Christian Dior, Guerlain, these are known worldwide, Givenchy. So you want fancy perfume for your wife at Christmas or your loved one at Christmas, and a lot of times we'll even go out and splurge on one of these names, even though we know it doesn't make a lot of sense for a bottle the size that we're going to buy, but we do anyway. So next slide, Mark. And the last one is the most surprising to me, and it's called selective retailing. I did not realize that they actually retailed different stores and different types of stores within stores. And the one that surprised me more than anything else was Sephora. We have Sephora stores around me here in JCPenney and in Kohl's department stores, but Sephora is a Louis Vuitton company. The lowest operating margin, only 8%, less than 8%. But there's a lot of things in Sephora. My grandchildren even shop at Sephora, and that's the only one of these things that my grandchildren would be dealing with, I'm positive. So they do have a place where even people that are comfortable, but they don't consider themselves ultra rich, but people that are comfortable can partake of their business at various times without feeling that they're being naughty in the process. So 5 different divisions. Next slide, Mark. And they're worldwide. They have a nice mix of business throughout the world. There's not one place where they're focused, 25% US, 25% Europe, about 30% Asia, a little bit in Japan, 7% in Japan, and then 12% in the rest of the world. So it's a worldwide company, but it's focused mainly where there's money, obviously. And that's because you need money to buy most of the products that they have under their umbrella. Next slide, Mark. If you're interested in the business mix, about half of what they sell is this fashion and leather goods with the extremely high margins to them. The smallest units are wines and spirits and perfumes and cosmetics, the liquid things, and those are the perfumes and cosmetics, especially some of the lower price. This selective retailing is getting to be a larger piece of their business. Over the years, it's grown from about 12% to most recently 21% of their business, and that's a 2% jump just in the last year for that particular business. So you see that they're focusing on that, even though it's a lower margined business. It's proving to be kind of a high turnover business. So you sell a lot of things, but you sell them at a much lower margin, obviously. Next slide, please. That's the top of this slide is from Morningstar, and Morningstar assigns LVMU assigns it a wide moat, and it assigns it a wide moat mainly because of the brands that it has and the fact that Louis Vuitton has been very, very eager to be acquisitive. They're not afraid to pick up a great brand wherever it happens to be, in whatever country it happens to be in, and they add it to the stable. And for the brand they're picking up, I don't think the people at Tiffany's felt that they were cheapening their brand at all when they sold themselves to Louis Vuitton. I think that Tiffany said, we're just placing ourselves along with many, many other very high-end, luxurious kind of brands. And that's why they get this wide moat idea from Morningstar. And I love wide moat companies. What that says is that they're kind of immune to competition. They're not going to go out of business next year because somebody else invented a better mousetrap and is going to beat them at their own game. They have so many brands and so many different types of products that they've made themselves almost imperviable to going under in the near future. Manifest, that's from the bottom of the slide, gives them a 97 quality. That's about as good as you get. And more importantly, gives them a par value, which is extremely attractive. That 16.4%, I think, is very attractive for our portfolio. Next slide, if you will. Here's the lines, and I have taken out the pandemic year, the height of the pandemic, 2020. I removed that because a lot of business in retail went bust during the pandemic, and that's understandable. And I also took off the very earliest piece of data. This was at a time when Louis Vuitton was just beginning to put together its stable of brand names, and it was kind of flat 2014 to 2015. So I took it off to get a better fit for that data line, especially on the sales line. I wanted to measure that sales line growth, and by taking off those 2 years, I was able to get the data, the trend line, to lie almost exactly on top of the data, and that was a really nice thing for me to be able to do. Next slide. Pre-tax profit margins stable to moving upward with the company. You look back to 2015 and then you move up to 2023 and you see that the margins have generally been moving in an upward direction. That's a good thing. Return on equity plus 20. That's an excellent thing. Debt to capital a little bit higher than we normally would like to see. So I went and I looked at the interest coverage and the quick ratio and the current ratio, and it appears that excuse me, Louis Vuitton is having no trouble at all handling their debt when I look at these particular numbers. The interest coverage is double digit. Anything double digit means that they're probably handling their loans with no problems at all. We have to understand also that these numbers that appear at the bottom of the SSG Plus, the debt to capital numbers, if you're a retailer, and Louis Vuitton is a retailer, then those debt numbers do include leases. And you'll notice there's a distinct drop or a distinct rise, if you will, either one, from 2018 to 2019. And that's when the new accounting laws went into effect in 2019. And you see a sudden surge in debt levels, and then they stayed relatively constant for the next 5 years. That's because suddenly leases have been accumulating now in these debt numbers. The powers that be said that you have to put those leases in the numbers you report to the SEC. And of course, Morningstar provides us with data that reports exactly the same numbers that go to the SEC. So that explains a lot about their debt as well. Next slide. Shows future sales and earnings of 10%. This is a very large company. In the most recent year, that's $93 billion in sales. This is a behemoth. And to achieve sales growth of 10% in a company this large, actually, the line that I showed you, the sales line, was measured at 11.7%. So to get that kind of sales growth in a company this large is really, really high class. I'm forecasting into the future 10%. And then I used a very, what I considered reasonable figure for the earnings growth, and I took it way down to 10 to see where that would lead me on the SSG. In other words, I just matched the sales because I know that over long periods of time, those two numbers will match. I don't get any estimates from Value Line or from Morningstar or from CFRA because there's no analysis report from any of these companies. It's a Morningstar report, but it's just all data. The analysis is not there from Morningstar. There's not even a data Value Line sheet. There's no CFRA sheet for the company. I do get some estimates coming from Yahoo Finance, a little bit from Morningstar that's reported right on our own SSG Plus, and of course I get numbers from Manifest that are based in Y charts data. Next slide. I use 30 times, which I think is very reasonable for a large blue chip company like this. 30 times for the future high PE, 20 times for the future low. You see the 5-year averages were 29.7 and 19.6. So basically I'm rounding those up and using them. The values give me an average PE of 25. Manifest is suggesting an average PE of 24. So I think I'm in the right ballpark. Next slide. Here's the calculations done for me. I'm getting a par value of around 13%. Manifest is getting a slightly higher number. I'm very pleased that this company pays a pretty nice, reasonable dividend. It pays about 1.5% on average, and at the average PE, it would contribute 1.7% to the par value. I'm getting about 11.5 out of the price appreciation and another 1.7 out of the yield. I like yield when you can get it. I don't force myself to buy only dividend stocks, but if I have a nice dividend as part of a stock I'm interested in, of course I don't turn my back on it. Next slide, please. My analysis of 13.2 is very much in line with the Manifest Prove number, the return on value number, which many of you that have been coming to a lot of our sessions are starting to use as a validation for your own studies. That 13.2 and that 12.1 Prove number are certainly in the same neighborhood. Maybe they're almost, 2 houses down from each other. And I do notice that my par value is a little bit more conservative than that, coming from the Y charts number of 16.4, but I still think they're in the same ballpark, the same general neighborhood. So all in all, I think Louis Vuitton, it's not a tech stock. It's a very simple business model. You sell luxury products to very rich people, and you do it all over the world. It's a simple business model. It has an attractive par value, an attractive sales growth value, and I'm suggesting that we add it to the roundtable portfolio.
All right, thank you, Ken. And I'm going to add a U to it to pretend that I'm not a hick and I can actually spell Vuitton.
All right.
All right, so sticking with this luxury, good smelling area, apparently, we turn to Georgia and Inter Parfums.
All right. Thank you, Mark. And thank you for setting the stage for the wonderful featured industry or business of the night, Ken. Ken's kind of giving you a picture of luxury items, and I'll stick with that with Inter Parfums, which you see the summary, good history in all respects, very steadily up and consistent. Of course, you see the COVID hiccup. Ken spent a little bit of time mentioning dividend. You see that Value Line's projecting over 2.5% dividend yield for this company. Notice that 18-month target also, Value Line's looking at about a potential 30% return over the next year and a half. So that's telling me that Value Line believes that it's undervalued immediately, and it's got a decent long-term forecast as well in the 11 to 22% range. So let's talk a little bit about the company. First of all, where it came from. I did what I usually do. I ranked the roundtable portfolio by par and just kind of skimmed, looking at either one of the companies that I follow or that I brought might be a good value right now, or something that somebody else brought that I'm familiar with or want to learn about. And anyway, the company that kind of jumped out at me as the best current value that I was comfortable with was Five Below. And I said, I'm really, let's see what is out there with this similar Five Below characteristics of about a 16 par, high quality of 90, and a good solid growth. I used 11%. You see both Five Below and Inter Parfums come in closer to the 12, but I was trying to broaden the search a little bit, and here's what came up. And I think I have seen Inter Parfums in various screens and so forth, and notice the Louis Vuitton is right in there as well. And it's very similar characteristics on this particular chart that you see. So it's not surprising. It's the theme of the night. So let's talk about the company. Next slide. This slide tells you in a snapshot a little bit what the company's about and a little bit about its finances. I've highlighted in green a couple of things that I'll mention. I won't read the whole slide to you. They're the top player in prestige fragrance industry, and they have low capital because they don't own their manufacturing facilities. Well, wait a minute, Cy. It says right up at the top, we manufacture, market, and distribute. Well, they contract their manufacturing out. Some pharmaceutical companies do the same thing. They develop the product and they set the specifications. And in fact, in Inter Parfums' case, they even actually act as the general contractor in acquiring the ingredients and the underlying materials, but they pay someone else to do the actual manufacturing. So they don't have the heavy plant costs. You see that the split of net sales is about 2/3 European and about 1/3 United States. Next slide. Here's their strategy. Focus on luxury prestige brands, grow their brands through new product development and marketing, and always look to add new brands to the portfolio. Inter Parfums doesn't develop most of the brands initially. As they mentioned here, they grow the brands through product development and marketing, but they usually acquire a brand through a licensing agreement or something from someone else, not unlike some of what Louis Vuitton was doing in their fragrance industry that Ken mentioned. Next slide. Here's a couple of examples that the company uses. If they acquired the name through a licensing agreement, Mont Blanc and Jimmy Choo, and you could see how it has grown over the years as they put their resources. I believe these are two of the largest brands for Inter Parfums. Next slide. They also, and again, I won't read this slide to you, but they are saying that they are a preferred partner of companies looking to expand their market. Expand from, you'll see one of the brands that Inter Parfums has is Coach bags, expanding from the handbag and leather goods area. Coach wants to expand beyond that, and so they enter into a partnership, a licensing agreement of the name to Inter Parfums that then deals with the marketing of the fragrance, the manufacturing, and then distributing. And they distribute in various ways. I believe there's a slide, either the next one or two, will tell us the ways that they distribute. Next slide. Yes, here it is. And notice here are some bottles for you. There's no Hennessy or champagne here, but this is the liquid and the bottles from the previous presentation by Ken, and they are high alcohol content, but please don't drink them. Just wear them and smell good. You see that the company is very global, 120 countries. They sell through direct affiliates, so direct marketing, but they also sell through distributors, and they also sell in duty-free shops that if you do any travel outside the United States or wander international areas of airports, you have seen duty-free shops. That's one of the areas that Inter Parfums distributes its products through. Next slide. Here's sales by brand. You see the Mont Blanc is the highest percentage of portfolio sales. Coach is right up there as well, and then the Jimmy Choo as well, and Guess, D&KY. And again, these are luxury item brands from other, from apparel or accessories that Inter Parfums takes the brand and provides fragrance using that brand, and then of course pays royalties to the licensor for the products. Next slide. Here's the company's long-term. This is a 22-year chart. You see a solid compound annual growth rate of sales of 14% over this time. That's a little faster than the 10 years that we showed on the stock selection guide, which is between 11.5% and 12%, including the COVID pandemic, which of course pulls it down both here and on the SSG, although a little bit more impact on the SSG since it's just 10 years. But again, you see a very strong record. And you notice that they formerly had Burberry that they discontinued as they transitioned some portfolio back in the mid-teens that they mentioned on this chart. So that explains some of the dip there in the middle. Next slide. Here's a bit of a comparison to the industry. I also wanted to highlight that they are expecting 10% growth in 2024. That was their guidance at the beginning of the year. The first quarter was a little under projections, but they reiterated that they still found 10% sales growth to be attainable. And they're 100% in the luxury arena and the market, and they expect to have about $4 billion in sales last year when the slide was prepared before the final results were in, and will be a little higher with the 10% growth this year. One thing that I did want to mention, and why I would say Inter Parfums is maybe a better luxury play than its competitors, to include Louis Vuitton, is what the company calls the lipstick effect. They don't sell lipstick, they sell fragrances. But lipstick is a luxury item, or in their case, perfume is a luxury item that, compared to handbags and major apparel, or cars, heaven forbid, the cost of a luxury car, that are much smaller ticket items than the big ticket items, and they hold up much better in economic downturns. So they expect that even in this rough economic environment, they'll continue to be able to maintain their growth and their market penetration, because people still want to spend those ridiculous amounts for that little bottle that Ken was talking about, because that little bottle costs a lot more, a lot less in dollars and cents, like maybe $100 or so, compared to $100,000 for the luxury vehicle, or several $1,000 perhaps for another apparel item or accessory. Next slide. Again, this is just reaffirming the guidance of 10% sales. And they do expect to take a non-cash amortization charge due to an acquisition. So their GAAP earnings will be lower than what they believe real growth is for the 2024 year, which they expect to come in around 11% on the non-GAAP basis, excluding this amortization charge. Next slide. And then this is just their record of growing the stock price over the last 10 years, about 20% a year. Certainly a good, consistent return to shareholders. Next slide. And it does have a growing dividend, not just a good dividend yield, but the dividend has been increasing. Here, you see the, just again, reminder of the first chart with the history in graphical form, and then you see the numeric history. I'm projecting sales to grow at about what they have over the last 10 years, although they've grown a bit faster coming out of COVID. But I think reverting to the norm is probably pretty much to be expected. And again, I expect earnings to grow a little bit faster than that, based primarily on margin increase. Next slide. Here are my actual projections, and you see, again, there I expect the taxes to go up a little bit, and I don't have any particular crystal ball or inside information, but the company pays a relatively high tax rate. Many companies tend to be more in the lower 20s or even the high teens, but historically they've been fairly close to that 27%, and I They were last year down at the 24.8 you see, but the trailing 12 months, the last quarter boosted up a bit. So I went with the higher tax rate record. I'm using roughly the 5-year average profit margin. Current profit margin is significantly higher than either the 16% or the 17%. But again, that seemed a good landing point. If we get higher than that margin, then certainly we'll be happy. And shares have been very steady. So just left those the same. And you see that my projections right at manifest for the next 5 years. And we're both a little more optimistic than our BI brethren and sistren, who have a slightly lower, but again, we're still all in the relatively same ballpark. Next slide. And then PEs, I just used roughly the 5-year average PE, which I covered up because of the arrow for the low PE. You can't see, but that's the 5-year average is 36. I believe the 10-year average was about 37. So actually the averages are very close on both the high end and the low end, as you can see. I chose not to go with the 23 average, but take the recent average of, the recent low of 17, which gives me 21.5, I believe. We'll see in a second if I'm trying to do my math fast. I think it's not 21.5, 26, 25.5, but we'll see it in the next slide. So next slide. 26.5. All right, there we go. 36 on the high side, 26.5 on the average PE. And I'm projecting, just based on payout, a little bit lower potential yield than Value Line is. But again, that's another percentage point perhaps that we could see. Notice the current yield is up in that 2.7% range. So it's just how quickly the company increases its dividend, but a very strong potential return of 17 using the average PE percent, or potentially as high as 23, 24%, which is again confirmed by the manifest consensus PAR, which uses a slightly lower growth rate and a slightly higher growth rate, slightly lower PE. So I'm adding 1,000 and piggybacking on the luxury item, but I think this is very attractive, as that yummy hot dog is.
Well, when
Where'd
I
that come from, Mark?
when you say the word prestige fragrance, this just kind of triggers.
There you go.
Cy, I have a good question for both of us from Bev out in the audience. She wants to know, are these both, are we buying foreign stocks? Are we buying ADRs? I know that I'm buying an ADR with Louis Vuitton. How about Inter Parfums, Cy?
That's a good question that I should know, because I usually pick up on that, but I am almost certain Inter Parfums is not a international company. I will check it as we start the next presentation and let you know, but I'm pretty sure it is a NASDAQ listed non-ADR company.
Okay.
Matt, you're right. The corporate address is Fifth Avenue, New York, and they do file 10Qs and 10Ks as U.S. companies, even as direct listing.
Yeah.
Okay, and then Bev has a follow-up. She wants to know, she said when she went to bank that she was advised not to buy stocks that paid a foreign dividend, and both of these stocks do pay a dividend. If yours is a U.S. company, that negates the need for an answer from Inter Parfums. I will tell you that Bev, that we have owned ADRs in the past in many of the clubs I belong to, and the foreign dividend issue has never been anything that held any real challenge for our treasurers to deal with. The software seems to handle it quite well, and the brokerage houses since they can sell them as ADRs in the U.S. here, the brokers are able to handle the dividend with no problem at all as well. There might be some money withheld occasionally to pay foreign tax, but that will appear in the accounting with no issue of any kind. So I'm not quite sure what you're referring to, but I know that these kind of stocks that are ADRs have been held in many club accounts with no real issue of any kind.
Yeah, that has always been a little puzzling to me too, Ken, because I have heard that, and the only thing I can ever figure out about it, I mean, you summarized it pretty well, but there is the ability to claim foreign income tax paid on a dividend as a credit on your tax return, and parceling that out through the partners. I would assume the software would handle it, but of course, certainly in the pre-software days, that's an extra distribution. But even if you don't do it, if the company makes you enough money, you're just giving up a little bit of a tax deduction or tax credit in that
absolutely.
case. And if it ends up being a huge amount of your portfolio, I'm sure you would gladly do the extra math. And if it's a small amount, you don't really worry about it. So
absolutely. We also have somebody out in the audience would like the ticker again for Inter Parfum. It's IPAR, if I'm correct. Am I right, Si?
Yes, that is correct.
Okay. IPAR for those of you asking for that ticker again. Okay, Mark, we're to your presentation then.
Okay, Hugh, would you like to make any comments at this point, or do you want to wait for mine? And just kind of curious what's on your mind. We're trying to guess what you might be wanting to kick around here tonight. So do you want to give it some thought, and then we'll come back to this slide?
Yeah, that makes sense. Yeah.
Okay. All right, mine will go pretty quickly. I'm gonna actually make a rare repeat selection by me. I basically went out there and went looking for fairly interesting companies. D-Local is an interesting study. It was presented by Pat Donnelly at the Better Investing National Convention. It's worth a closer look, and it showed up on this particular screen. I screened 4 companies that were trading at a low relative strength index, potentially oversold. They could be beat up a little bit, and it does show on some of the prices. Sunoco is a company I've always been interested in, along with Bemis and Aptar Group. They are in a little bit of a recession, and it shows up in the sales, so probably not going to be terribly interested in that. Another packaging company, Myers, it's a company that our club owned many years ago, kind of showed up. Then ResMed showed up. They took a pretty good hit with the most recent news from one of the obesity companies, Lilly or Novo, both. I think Lilly's the one who filed that, showing some good characteristics for apnea patients, and that once again has punished our ResMed stock. Len Douglas is keeping track of that in the forum for us at Manifest, so that's come around to rear its ugly head again. And then last but not least, the company that I presented last month, NICE, the customer contact / artificial intelligence firm. We're going to be going into that in greater detail. I like the projected annual return that we see here, very high quality. This is both good for our portfolio. Check on the prove, a good RSI showing interest. Value Line likes it a lot, 19 to 20% return. And you can see it's trading at a discount according to all these people. This all checks. So we'll continue to follow our interest in this company. Again, just wanted to repeat that these guys are kind of famous for actually doing AI before it became a buzzword. So I thought I'd repeat what we looked at last month, only I've made it bigger because I think it is a fairly big deal. They've been doing it since before AI was cool. And the market for this is expected to increase at a fairly dramatic rate over the next several years. And again, here's your evidence that their CEO at the time was talking artificial intelligence well before everybody else had it at the tip of their tongue. And that's all fact. Here is the company. They basically started in the customer engagement contact center type business. They have branched off into financial crime and working with police departments and law enforcement. And basically, they are renowned by a number of people. We'll see who that is here in a second, but by a number of their clients and partners for the efficiency that they deliver when it comes to call centers and basically the business processes enabling commerce and taking care of customers. Question I didn't answer or didn't bring up last time around, they are incorporated in Israel, so they're probably impacted by some of the stuff that's going on there. But as they point out, much like InMode, a lot of their revenues come from outside Israel. Okay, I'm not going to spend a lot of time on this other than to make the point that they work as partners with a lot of people. We've been talking about the consultants a lot here tonight and in recent bull sessions. That's this group here and this group here, especially this group here, the global system integrators. So they work with a lot of different companies. You'll recognize a lot of those logos. They also work for a lot of the major companies that you would know, including the top 10 health insurance companies and a bunch of the financial companies and 6 of the top 10 in the Fortune 10. So again, no slouches whatsoever. Here is the situation. They have been firing on all cylinders for the better part of 20 years. They hit a bit of a speed bump. They are in a transition going from their legacy software to cloud delivery. So some of that is involved in some of this uncertainty that you see here. The market got a little bit uncertain, and it has been punishing the company in the last several weeks. One of the comments that I had made was the only thing that would bother me about this company would be if that CEO that had been with the company for 25 years would happen to be come up missing or decide to enter early retirement. And sure enough, he quit his job within the last couple of months. He is sticking around for the rest of the year, but that is a moment. Definitely. The stock price has gone from 200 up to 260 earlier this year and basically dropped about $100 a share down to where it recently is around 160. Here's a closer look at the company over time. Again, the quality is stellar. It's ranking up near 100. The projected annual return is at multi-year highs. And we see the upstraight on parallel characteristics going on here. It's good to see that it doesn't seem to be as vulnerable, I'm knocking on wood, to the consulting enigma that's going on right now. But you're looking at a company with 10 to 12% growth rates, very consistent margins. We'll get a closer look at that here in a second. PE in the 20 range, a projected annual return of around 20%. Which is verified down here by this projected return on value. Very strong financial company, very high quality ranking. Notice that as in the highlighted box, they basically have as much cash in their wallet or checkbook as they do in total liabilities. That's long-term debt and current liabilities. So all liabilities are covered by cash on hand. And you can see that to generate a return of 14.8, you'd only have to buy it at 210 or so. So I borrowed one of my grandson's trucks and said, let's back up the truck here. We're at 160 versus 210, so pretty good situation. Here's some of the other highlights. You're looking at the profitability profile for the company going back over the last 10 years or so. Their operating margins have stabilized. If they did hit a speed bump or a hiccup or whatever this is, it does appear to be stabilizing, and they are talking about that. So between that and the bottom line for the net margin, pretty nice looking profitability picture. Much like Hugh likes, they are trading near their 52-week low, so down around 7%. That's definitely below the 20. Value Line likes it at about a 20% low total return forecast, and you can see that both Morningstar and the analyst consensus is checking in at nearly a 40% discount to fair value. So we like that a lot. Here is that 25 relative strength index that I started with. So again, a pretty positive situation here. Very easy to defend a PE in the low 20s. And in the value line recent write-up, you can see that they're talking about numbers which match very favorably to the earnings growth forecasts of 17 or 18%. The company itself and value line is talking 19, 20, 21. So all is good here.
Mark, same question for, oh, you have more, I'm sorry, continue.
Yeah, just a quick addition to some of the stuff that I kicked around last month. I used to use this chart religiously in my investment club. If I wanted to argue on behalf or promote a company, I would read the bull's side. And if I wanted to argue with somebody about, perhaps get something voted down, I would just read the bear side. No, I didn't do that. I think it's good balance to try to judge this type of stuff. Again, this is a company with a formidable presence, incredible retention of clients that they've got. Even as they go into this new area of business, I think they're probably going to experience superior retention. I'm not even sure that they can say the word churn at within the walls of their company, but they do talk about it here at Morningstar. Again, I look at these bearish commentaries and just wonder, yeah, I acknowledge that change can be very challenging for many of us, but I call that Tuesday. It's just Tuesday. As they expand into some of these other areas, that stands for small and medium-sized businesses, SMB. It does only represent 20% of revenue. So even if they experience a little bit more churn than they're used to, they're only talking about 1/5 of their business, and the other 4/5 is running over here. So again, that doesn't bother me a whole lot. I don't think that there's an incredible threat. And then there's just this notion of competition for shelf space and serving a company. And again, they don't want to be displaced, but sometimes that avoidance of displacement can be to their advantage. In other words, once they're already got their feet in the door and they're working with a particular client, it can be a real barrier to unseating them. So they're the incumbent, and it can actually be quite a strength to for the company going forward. So I'll leave with this slide, and then we can go to Ken's question. Just be nice. Be nice to everybody out there.
Same question for you, Mark. There was a notice that the company was headquartered in Israel. Are these ADRs?
Wow, I don't know. I don't think so, but I'll have to check.
Okay. And Diane Grace has her hand in the air, and Diane, I'm going to unmute you. And it looks like you're unmuted, Diane.
Hey, Diane.
Nope, she took her hand down. Okay, so we'll continue. I'm getting from Therese that NICE is an ADR, Mark.
Okay.
Therese in our audience is saying that it is an ADR. So that would mean the same situation as Louis Vuitton, but not Inter Parfums. Inter Parfums is a U.S. company, okay? Go on, Kevin, with your question.
Mark, does this have any exposure to New Zealand or any kind of milk companies?
Not that I'm aware of, Kevin, but they could have that company as a client.
Thank you for the question, Kevin. I'm going to unmute Herb. Herb has his hand in the air, and Herb, you're unmuted. Go ahead, Herb.
Okay, just to let you know that when we did an ADR for our club, we had like 8 pages of K1s, and without an ADR, it's only 1 page of K1s. So it does make a difference on your tax filing.
Yeah.
So you're going to use up a little bit more paper when you're printing your K1s then, right?
Yes.
Okay, but if you're filing electronically like we can file now, that's not making a heck of a lot of difference with our filing anymore then, is that correct?
That's correct.
Yep.
Okay,
and also, as I mentioned in an answer to, the foreign tax credit is optional. I mean, you're not required to take it. If you want to give up that money because you don't want an 8-page K1 or pay your CPA extra, just don't do it. And
Yeah,
if you make a lot of money and it makes a big difference, then I don't mind doing it. So
Yeah, I can remember we had a British company in our club back in the 1990s, and all we had to do was file a little bit of extra paperwork, and it wasn't substantial to basically recover those withholdings.
And
yeah.
Bev, who asked the original question, did clarify that at the class, the reason given for not getting into where they were paying a dividend from a foreign company was that you were going to have your CPA charging you more to do your taxes because they had to fill out more forms, and they charge by the number of forms they have to fill out. So there's nothing legal about it. It's just if the CPA is going to pay more, or if you're going to have a few extra pages and you have to weigh that, and Sai's absolutely right. There's no reason you have to claim any of that stuff.
Yeah, I do know that I have owned a number of ADRs for a number of years, and Toyota, for example, and I've not experienced any of the foreign withholdings or any additional paperwork. So it's kind of a mystery to me too. What they would have been getting at. All right, so can we turn it over to Hugh? And Hugh, we're willing to go wherever you would like us to go. Got a little bit of time.
Well, as you know, I didn't have time to do anything today since, well, I fell asleep actually just shortly after I was supposed to have lunch. I just got back yesterday from Europe, and I'd spent a week there, so normally I'm flying back and forth, so jet lag doesn't bother me. Since I spent a week there, I did. And that whining you in the background is an Irish wolfhound. Thinks I should be talking to him. I love the fact that you're buying these luxury brands. They're very recession-proof, I've noticed. I don't know if you looked at the behavior of these companies and the revenues in the recessions, but they tend to be significantly more non-cyclical or recession-proof than other companies. Recently, because I haven't bought any of them yet, but I've been stalking them for a while. Recently, they've started to appeal more to an aspirational group, which is, I guess, middle class to upper middle class. And it seems that young people are driven by them as well. I have never understood it in clothes. I've never understood why people pay more for clothes so they can put a commercial on it for the brand. I've never really but a lot of people do it. And very often it's people in the lower socioeconomic bracket that tend to like these things. There's two things I was reading about a couple of years ago now at this point. The problem they have with fakes, particularly obviously Coach bags, but perfumes as well. Everything really, watches, Rolex being a good example. That's one big issue. But then the counteracting that is the fact that these are taken off crazily in China, for example. Asia,
Yeah. Definitely.
Where they have stores all over the place. I don't know if once that gets saturated, whether things will roll to a grinding stop, but we will see. I should be able, by the way, to talk more freely about Ardelyx at the next session. And I was thinking of reaching out to somebody there to find out if they would come and talk to Mark obviously first, chat about this. Somebody from Ardelyx to come and chat about the company. Obviously, sure. They can say in public, but the CFO has been fairly open to speaking to individual investors. So, to the extent that he can, he might be able, as long as it's obviously not during quiet period, he might be open to speaking to a group of investors. He's aware of this group and he's aware of their loyalty for the last 8 or 9 years, I think, at this point. I can't remember when Ardelyx was last formed, but it is some time ago. But as I'm going to be switching jobs starting on July 1st, so it'll give me a bit more flexibility there.
Well, thank you, Hugh.
I didn't get a chance to look at any company this month at all. As Mark pointed out, I tend to screen first by a 52-week low, or if it's a 5-year low, even better. And I tend to look in the biotech sector for car crashes, major problems, companies collapsing, clinical trials going south, etc., just to try to figure out exactly what happened, because very often that's where I get the best returns of all. Being an ambulance chaser, a bit of a tongue like ambulance chaser in biotech can be very, very profitable.
But you like smelly companies that are more than or less than 6% above their 52-week low, right, Hugh?
I'd like them to be as low as possible. It just saves a lot of work. I love it. My cliche here, but I love it when bad things happen to good companies, particularly because a lot of people run.
Well, I'm gonna now give the audience a chance to vote on what they'd like to put in the portfolio. So I'm launching the poll. It's now open, and folks, you can vote for which company you'd like to put into the portfolio. Here's the three that we presented. You can vote for none of the above, and we'll see where we go with it here. We'd love to have 80 or 90% of your voting. We're already up to almost 60%. We're at 60% voting now. So if we can get a few more folks to vote, we just hit 75%. So let's keep on it moving here. A few more of you have to press those buttons and give us a vote. We just hit 80%. Let's see if we can push it to 90. I'm going to kind of count to 10 and then see where we end up. The votes are still coming in. Keep pressing those buttons, if you will. And I'm going to close the poll, and we're going to have one happy guy down in Rochester Hills here. Okay. Mark, you got as many votes as Cy and I did together. The perfume guys split the vote, Mark. Okay.
Hey, so there will be no runoff election?
No runoff election. No, we're second and third.
50%. You have to get over 50% to avoid a runoff.
I'm going to regret putting you in the back room, Kevin. Be quiet right now. Okay.
Hey, he's an expert.
I'm here for you, Mark.
He's an expert.
So we're going to put another $1,000 into NICE then, and hope that it pays off. And I'm going to hide the poll. And Mark, I think we have one more slide just to show folks what's coming up. It's the summer, so we don't have a lot coming up. We do want to announce the next roundtable. It will be the last Tuesday in July, and that's dated the it's July 30th. July 30th, right? So that's the next roundtable coming up,
and will be our 14th anniversary.
Yes, it will. And we don't anticipate moving off the last Tuesday for a couple of months. Remember that we have moved now this is our third time at 8 o'clock, and we're going to continue starting these sessions at 8 o'clock Eastern time on the last Tuesday of the month, unless a holiday gets in the way. And we thank all of you so much for coming. It's greatly appreciated. Thanks to Kevin and Matt in the back room for handling some of the questions. Mark and I and anybody else that wants to are going to stick around to answer a few of the questions that we have back here. We do have a YouTube channel. We'd love you, if you've never been there before, we'd love you to go to the YouTube channel and subscribe so we can get our number of subscribers even higher. But the YouTube channel, you can find it by Googling either Roundtable or Manifest Roundtable or Manifest Investing, or any combination of those words will get you to this channel. And every single one of our presentations since we began this program almost 14 years ago is here for you to look at. All of our great things that we did and all of the boneheaded things we did are here for anybody to take a look at. So we urge you to go if you're missing something, or if you just missed some time and would like to hear what we were talking about. It's right there for you to take a look at YouTube. Again, thanks to Cy, thanks to Mark. And thank you for coming to the session, folks. We're going to close the recording now, and we will try to answer a few more questions that we have in the blocks right here, okay?
Thanks, everybody.
I'm
Take care out there.
okay. I have a question here. I'm